4 legal scams, billions of dollars, 0 prison time, and the last one is happening to you right now. Today we're looking at 4 schemes that made people obscenely rich. Not through hacking, not through fraud, through the law itself. 4 stories where the system didn't fail by accident, it worked exactly as designed. Most people think financial crime means someone broke the rules. But the most expensive moves in history, they were made by people who understood the rules better than the people who wrote them. I've spent a long time digging into these 4 stories, and what I found will genuinely change how you see money, power, and the economy you live in every day. We're going from shocking to absolutely unbelievable. The 4th story helped crash the global economy. The 3rd one is why your prescriptions cost a fortune. The 2nd one involves a country that fought to give back billions of dollars it was owed. And the first one, the one that hits hardest, is happening right now in real time to every single person watching this. Let's get into it. Number 4, the accounting trick that helped crash the global economy. The year is 2007. Lehman Brothers is one of the most powerful investment banks on the planet. Marble lobbies, thousands of employees, and a reputation built over 150 years. But behind the scenes, they have a problem, a massive one. They're sitting on over $80 billion in risky mortgage-backed securities, and the housing market is starting to crack. Every quarter, Lehman has to publish financial reports showing how much debt they're carrying. If investors saw the real number, they'd panic. Stock prices would collapse, lenders would pull out, the whole thing would unravel. So Lehman needed to make billions of dollars in debt temporarily vanish. And they found a way, a perfectly legal way. It was called Repo 105. Here's how it worked. Right before the end of each financial quarter, literally days before the report was due, Lehman would sell billions of dollars in assets to another bank. On paper, it looked like a real sale. The debt was gone, the balance sheet looked clean, investors breathed easy, confidence held, but here's the catch. It wasn't actually a sale, it was a short-term loan disguised as one. A few days after the report went public, Lehman would quietly buy everything back. The debt was right back on the books. Nobody noticed. And next quarter, they did it again. They used this trick to hide up to $50 billion, quarter after quarter, for years, right in front of regulators, auditors, and investors who had no idea what they were looking at. And the wildest part, they couldn't even find a US law firm willing to sign off on it. Not one American firm would say it was legal. So they went to a firm in London, where the rules were just different enough to make it work. A legal opinion from across the ocean was all it took to hide $50 billion in debt from the entire financial system. When Lehman collapsed in September 2008, it triggered the largest corporate bankruptcy in American history. It helped set off a global financial crisis that cost millions of people their homes, their jobs, and their savings. Entire economies contracted. Unemployment spiked across the world. Families lost everything. Nobody from Lehman went to prison. Repo 105 was technically legal. The loophole wasn't even closed until 2011, 3 years after the damage was done. But that's just number 4. Because as wild as Repo 105 is, the next one hits closer to home. This one affects you every time you walk into a pharmacy. Number 3. The pill that changed color and cost you thousands. If you've ever looked at a prescription price and felt your stomach drop, this story is going to explain exactly why that happens. And it's going to make your blood boil. When a pharmaceutical company invents a new drug, they get a 20-year patent. During that time, no one else can make a generic version. That's the deal. You invested in the research, you get a temporary monopoly to make your money back. Fair enough. That's how the system is supposed to work. But here's what some companies figured out. When that 20-year clock is about to run out and cheap generics are about to flood the market, you don't need to invent a new drug. You just need to change something small enough to file a new patent. Change the pill from a tablet to a capsule. Make it extended release instead of immediate release. Change the color, adjust the dosage. It doesn't have to be better. It just has to be different enough to get a new patent approved. They call this evergreening. The pharmaceutical industry calls it life cycle management. Same things. Nicer name. Take the Alzheimer's drug Namenda. It was a blockbuster. Billions in annual revenue. When its patent was about to expire in 2015, the company didn't just accept the loss. They launched a slightly tweaked version, a longer acting form, and started aggressively moving patients over to it. Why? Because once patients were on the new version, the old one would go generic, but nobody would be taking it anymore. The monopoly continued under a new name. Patients stayed on the expensive version without even realizing a switch had been made. And it's not just one drug. A study covering 2005 to 2015 found that 78% of drugs associated with new patents were not actually new drugs. They were existing drugs with minor modifications. Of the 100 best-selling drugs in America, more than 70% had their patent protection extended at least once. But here's the detail most people never hear about. To protect these weak patents, companies often pile dozens of them on top of a single drug. It's called patent thicketing. One drug, the arthritis and autoimmune treatment, Humira, accumulated over 100 patents. Not because there were 100 innovations, because each patent is another legal wall a generic manufacturer has to fight through in court. And most of them can't afford the fights, so they give up. And the expensive version stays on the market unchallenged. Every single step is legal. The patents are approved by the patent office, the drugs are approved by the FDA, and Americans pay the highest drug prices in the developed world because of it. That's number 3, and it's infuriating. But number 2 is where things get truly bizarre, because this one involves a government, an entire country, that was handed billions of dollars and tried to give it back. Number 2, the country that helped the biggest company on earth pay almost zero tax. In the late 1980s, Apple figured out something that would save them hundreds of billions of dollars over the next 3 decades. They did it with a structure so elegant and so audacious that tax experts gave it its own name, the Double Irish. Here's how it worked. Apple set up 2 subsidiaries in Ireland. Both were legally Irish companies. But here's the trick. Under Irish tax law at the time, a company incorporated in Ireland didn't have to pay Irish taxes if it was managed and controlled from somewhere else. And under US law, a company didn't have to pay US taxes if it was incorporated in another country. So Apple's Irish subsidiary was incorporated in Ireland but managed from the US, which meant Ireland said, not our problem, it's managed in America. And the US said, not our problem, it's incorporated in Ireland. The company existed legally in both countries and was taxed by neither. It floated in the gap between 2 tax systems and owed nothing to either one. Apple routed its profits from sales across Europe, the Middle East, Africa, and Asia through this structure. During the period the EU later investigated, 2004 to 2014, Apple shielded $111 billion in profits from taxation. In 1 year, one of their Irish subsidiaries paid an effective tax rate of 0.005%. That's $50 in tax for every $1 million in profit. $50. And here's what makes this even more mind-bending. The Irish government wasn't a victim. They were in on it. Documents released to Ireland's National Archives show that as far back as 1984, Irish government ministers were actively seeking legal advice on how to help US corporations avoid taxes by operating from Ireland. This wasn't a loophole that was accidentally discovered. It was a loophole that was deliberately designed, built by the people who were supposed to be collecting the taxes. When the EU finally stepped in and fined Apple 13 billion euros, the largest tax fine in history, Ireland actually fought the ruling. The Irish government went to court to argue that Apple should not have to pay. The country that was owed the money tried to give it back, because the arrangement was worth more to Ireland than the fine. The jobs, the headquarters, the prestige of being Apple's European base, all of it depended on keeping the deal intact. The Double Irish was officially closed to new users in 2015, but companies already using it, like Apple, were given until 2020 to wind it down. And by then, replacement schemes were already in place. Same concept, new name. The game continued. Every single step was legal. Now, all 3 of those stories are shocking, but they're also somewhat distant. A bank that collapsed, a drug you might not take, a tax structure in another country. The 4th story is different. This one is personal. This one is the reason the gap between the ultra-wealthy and everyone else keeps growing. And it's happening in plain sight. Number 1, the strategy billionaires use right now to pay less tax than you. This isn't a historical curiosity. This is happening today. And it's how the richest people in America legally pay a lower effective tax rate than their own employees. The strategy has 3 words: buy, borrow, die. Step 1, buy. Billionaires don't earn salaries the way most people do. Their wealth is in assets, stocks, real estate, and companies. And here's the critical thing to understand. As long as you don't sell those assets, you don't owe any income tax on the gains. Your net worth can go from 1 billion to 100 billion, and you owe the IRS exactly 0. Because those are unrealized gains. You haven't sold anything. In the eyes of the tax code, nothing has happened. There's nothing to tax. Step 2, borrow. But you still need money to live on. Private jets, mansions, yachts, those don't pay for themselves. So instead of selling stock and paying tax on the gains, you go to a bank and take out a loan using your stock as collateral. The bank is happy to do it because your collateral is worth billions. And here's the key. Loan proceeds are not income. You don't pay tax on borrowed money. So you get to spend the value of your wealth without ever triggering a tax event. And the interest on that loan, often tax deductible. So not only are you not paying income tax, The loan itself reduces whatever tiny tax bill you might have from other sources. You are being paid, in a sense, to borrow. Step 3, die. When you die, your heirs inherit your assets. And here's where the real magic happens. Under current US tax law, when assets are passed to heirs, the cost basis resets to the current market value. It's called stepped up basis. That means all the gains that accumulated during your lifetime, the entire difference between what you originally paid and what the assets are worth now, are completely wiped from the tax record. Gone. Never taxed. Not by you. Not by your heirs. Your heirs can sell the assets immediately and owe zero capital gains tax. Or they can hold them, borrow against them, and repeat the entire cycle. The wealth transfers. The debt disappears. The tax bill never arrives. This is how ProPublica reported that some of the richest Americans, people worth tens of billions of dollars, paid an effective federal income tax rate of less than 1%. Some years, they paid zero. Not because they cheated, not because they found a clever loophole, because the system was built this way, specifically for people in their position. And the detail that really puts this in perspective, a teacher earning $55,000 a year pays a higher effective tax rate than someone worth $100 billion. Not because the billionaire has a better accountant, because the tax code treats income from labor differently than income from wealth. If you work for your money, you pay. If your money works for you, you don't. Every step is legal, every strategy is available to anyone wealthy enough to use it, and it has been this way for decades. If any of these stories made your jaw drop or made you genuinely angry, drop a comment below. I want to know which one hit you hardest. Was it Lehman hiding $50 billion in plain sight? The pill that changed color so the price couldn't come down? Apple paying $50 in tax per million in profit? Or the Billionaire playbook that's running right now, in real time, while a teacher pays more in taxes than someone worth $100 billion? Let me know. And if you want more videos that pull back the curtain on how money actually works, not how they teach it in school, but how it really works, subscribe. There's a lot more coming. And the next one might change how you see your own paycheck. So there you have it. 4 schemes, all legal, all brilliant, all designed by the smartest people in the room to extract the maximum amount of money from the system without ever crossing a line that would land them in court. Lehman hid $50 billion in debt and helped crash the global economy. Pharma companies changed the color of a pill to keep charging you 10 times more. Apple paid $50 in tax per million in profit with the full cooperation of a government that then fought to keep it that way. And the richest people alive pay a lower tax rate than a school teacher, not by accident, but by design. The common thread in all 4 stories isn't genius, it's access. Access to lawyers, accountants, lobbyists, and lawmakers who build the rules in the first place. These aren't bugs in the system, they're features. Built by the people who benefit from them, maintained by the people who profit from them, and largely invisible to everyone else. The scariest part? Most of these systems are still running, right now. While you're watching this, that's the real lesson. The biggest advantages in modern finance don't come from breaking the rules. They come from understanding them better than everyone else and having enough money to use them.